Oh, thank you for that eruption of applause. Appreciate that, and the energy in the crowd as we round out the day here. Thanks for sticking with us here at the final session of the day, and welcome back to the disco. Actually wanted to just kind of bring some energy back in the room, in the silent disco, playing a little bit. So, but we got a great session here. Going to be covering a lot of ground in the private markets, breaking it down into venture, OTC, and credit. Have the perfect lineup to do so. So let's just go down the line for some intros on personal background, firm or fund you work for, and what you cover most closely in private markets.
There you go. Omar from Second Lane. What we do is basically trade on equities, safes, softs, whatever you can imagine in the last 9 years. That has been our bread and butter in this space. I'm one of the co-founders out of the 5. So I'm going to hand it over to Samantha. Go ahead.
Thank you. I'm Samantha. I'm with Rockaway. We've got a crew here. We run venture, liquid, and market neutral strategies. So all crypto. And we've been at it since 2020. Prior to that, I was at Digital Currency Group for about 4 years.
Hey everyone, James Newman, Managing Partner, Fund Manager at Republic, where I run our flagship venture fund, focusing on next generational founders across infrastructure and application layers.
Michael Bucella, co-founder and Managing Partner of Neoclassic Capital, or early stage venture investing firm. Over the course of 8 years, I've done everything that I think this panel is on: OTC, venture, credit, hedge funds, market neutral. There's little I think I haven't touched in this world, and previously had a firm called Block Tower. That's it.
Yeah, and thanks all. So right now, in crypto markets broadly, I feel like a lot of the attention's on liquid markets and in the public scene with IPO and that sort of activity. But how would you describe the state of private markets, and what are you watching closely in your respective areas? Whoever wants to take a stab at it first.
Should I? So what we have done in the last 12 months, there has been a growth of the equity side of the space. Previously, everybody's looking at the tokens and checking the tokens out, like how do the tokens perform. But when Circle moved into the IPO range, from that point on, we were trading Circle at $20 at some point last year, 9 months ago, I would say. And then it jumped to 60, it jumped to 200. And that was the pivotal moment for the state of the market at the current situation itself as well. Right now, all these names like BitGo, Kraken, FalconX, and many others will slowly follow in that range. And then the new thing that has emerged is the hybrid model of equity and token, which was there, but it didn't excel at that level. But right now, everybody's looking at it. One of the best examples would be probably Polymarket, which everybody's looking at and seeing how it will perform. The last piece of this thing is the evolution of the market on our side. Previously, 2 years ago, if you had asked me like how the OTC is on the liquid side, I would have said 95% tokens and 5% equity. Right now, it's like 60% token, 35% equity, and 5%, 10% hybrid model setup. That's a total different landscape than a year ago. So, go ahead.
It's an interesting point you make about the whole equity plus warrants model versus pure tokens. And some of that has been driven by, obviously, the growth equity side of stuff, where companies have actually been able to see exits via the equity route. And certainly from a kind of investor perspective, the equity type of offering certainly has better kind of regulatory or at least legal guardrails regarding what you own. I think the second part to it is really, in terms of if you buy SAFs or tokens, the question of like what you own is part of it, and also the incentive mechanisms. My preference is really about the kind of equity plus warrant models, because in terms of the value accretion, it's not necessarily clear whether something will accrete towards the token or the equity in the end, whereas token models often offer those incentives further down the lines.
Yep. Oh, go ahead.
So when Omar was speaking, it made me remember, I almost well, I'm already shuddering from the cold, but it made me double shudder because I was remembering kind of late 2022, 23. I was still at TCG. We were trying to raise money in the book, and I was trying to sell our Circle equity. And it was like a gruesome experience. And when you're selling, no one's buying because people would start flirting and like chat, and then they try to dial it down. So one thing that occurred to me was just there's so much more infrastructure around that in the space. Like, I don't know that your firm existed then. I don't think so because it felt very direct and informal. And also there were kind of so few people who had any mandate to look at that. And I think that's also what changed. Like now, not only are there traditional players that will take longer term views on crypto companies, I think maybe it's helped that they've seen at least a flurry of IPOs, that they see exits possible because of the regulatory landscape. But there was just, to speak in crypto, there was no liquidity in the market. And so yeah. And then I guess on the token equity, I think, James, you kind of like nailed it there. And I think we're very aligned on looking for both and not, kind of being fearful if you have some rights, but some other guy might have better rights. But I think there's also been a trend in private markets of just because a lot of these tokens that have no purpose fall on deaf interest. Like, I'm sure I'm saying something that's been echoed earlier in the day, but there's such a kind of look for tokens that have either a real reason to exist, right, that they create some sort of collective value or behavior that the system relies on, or that they are kind of not a security dancing as a security, but basically that they are associated with a thing that makes money. And so if you're investing in something that makes money and that the token, you're going to want to have a part in both, especially if it's a market that increasingly is rewarding things and behaving with valuations as if it's looking at traditional equities.
I would say, yeah, the conundrum right now, I think, for private investing is either you're in a sector that is one of the few that every eyeball is on, and so you're paying up enormously for private rounds, or you're doing something highly differentiated or contrarian, in which case you're second guessing whether you're doing the right thing when the rest of the market's telling you you're potentially not. So you need to be a little bit more forthright in your opinions. You need to have a lot more confidence in the things you're doing, because every sector right now is not getting the type of love that we've seen in historical cycles. So you have to make that decision. Do you want to be contrarian or potentially early to something brand new, or do you want to be momentum oriented and have to pay up and hope that you can retain those valuations as markets progress? And we tend to do more on the token side, or equity and token side. And so we rely on, what I think is ultimately FDV. In rare instances, we'll do non-token related deals, and that's where, we mentioned credit's one of these pieces. We just did a deal where it's primarily on-chain credit, on-chain merchant bank. Again, we were early on that, and now it's doing an enormous round that I think is good for them. But I kind of am curious if we would have invested at that stage. But again, it's an area where there is adoption from the market. It can be, these are areas, private credit, for example, it's a multi-trillion-dollar asset class in the near future. Yeah. There's a lot of opportunity and a lot of ways to structure that early on that make it more attractive. So you have that conundrum as an early stage investor, and then you're also just seeing this bifurcation in capital flows. You're seeing a lot of hedge fund and some venture fund capital flowing into DATs and private market secondaries. One of my closest friends is a friendly competitor over at Forge, and I keep very close track of what's happening on the secondary markets. It was, much, much easier to be a buyer a few years ago. It's now more difficult because the bid asks are quite wide as public market IPOs are pricing where things are trading, and you have disparities like, Figure versus Gemini. They came out around the same time, obviously very different outcomes. So I think those markets we're flush with cash, and now people are starting to take pause and sort of see how things play out. In the DAT space, see how liquidity plays out. In the IPO space, see how pricing and comps play out. So, yeah, and that's drawing capital from early stage. So early stage is getting a little bit orphaned, which there was a fellow on stage earlier, Ray, who mentioned that at some point he thinks, early stage venture could be an area that is self-correcting and could be attractive at some point.
Yeah, super helpful overview across the board. There's definitely a lot in there want to dig into. I think a good place to start would be kind of the equity token distinction. since that's relatively newer as kind of the public markets are heating up and there's kind of a lot of deliberation. But in the secondaries market, Omar, how do you see that kind of playing out, and what's been impactful about that recently?
So a couple of things in the last couple of weeks that happened, and most of the people have seen it. Like, as Mike mentioned, the gap between buying and selling is like in our side, like 10, 20% sometimes. And at our end, we just get frustrated. Like, guys, come on. We're talking about 10%. Take it, move on. You will make this investment into something else and you get the return on those. But sometimes the sellers are pretty strict, or the other side, the buyers are strict. They're not. This is our mandate. We're not going to move. What Samantha mentioned on their side, on Circle, at the same time that you were looking, there was an employee tender offer as well around that time. And nobody was willing to buy that. They were like, nah, overvalued. You're not going to buy this. But going to your point, Bennett, two things. Plasma, we saw the movement there, how the token performed and how the people could buy the day one and then the vesting and everything. Second, poly market, it jumped to 9 billion on our end. And right now, I'm just going to name one of the early investors there, Parafy, for instance, has a huge position on poly market. And I would probably say, from my perspective, if I were a founder, I would say, you know what, you need to liquidate a portion of your vesting because it's way too big to be going into IPO or whatever kind of setup. And then just to pick another point on that, poly market employees don't have any shares in the company, like nada. So what that means is that those guys would probably need to have a portion of the token as well. And that's where the point where it hinges on, like, okay, should you be doing both? Should you be launching a token and also a IPO at some point or not? And that's the question that we on our side struggle with. But what happens there is either the founder goes and they choose the option of both, or the investors push them to launch the token, because it's far better for them to just get it and get quicker liquidity.
I think you have to know your audience, or know your mandate, or know your geography. So, for example, we all say, oh, not every business needs a token. If you are a founder with an audience and user base that's primarily Eastern Hemisphere, you're more inclined to do it because they are a much more crypto native audience. There's massive, massive liquidity there that doesn't necessarily exist across the board here in the States. So I think the States has moved towards a position of, I need to make sure I'm holding the mic right. The guy in the back kept yelling at me. There was a movement towards kind of removing the token aspect to a lot of early stage deals, but that never was the case in Asia. And actually, a fair amount of deals still try and go pure SAFT, which is very uncommon now in the States. So I think if you understand your market, know your audience, then it works. There's also kind of like, someone mentioned a mullet DeFi earlier, but there's ways to enter into the token world through equity that, so I mentioned the on-chain, merchant bank or credit deal, they are going to be very interactive with protocols that do have tokens, and they're going to be lending on those particular protocols, lending in their applications, and they'll be accumulating tokens through the structuring of those deals alongside the credit aspects of the terms. And so from that regard, you can be a, Western, I'm investing in the equity, not the tokens. I'm a very traditional type of investor in this market. But in reality, you're accumulating an enormous amount of value through the tokenized world. And yeah, so that's another way to play it. And I think the West prefers it that way. I think there's a little bit of hesitation to say you're a token-based investor. I say it proudly. I say I'm in crypto and I'm a token-based investor.
Not to be confused with a token-based speculator.
Exactly. No, I'm an investor until we need liquidity. And then I think, as you mentioned, it's good to have your liquidity dispersed across a number of investors, a number of holders. But anyway, all that to say is know your audience, know your geography, know your market, and that will literally dictate what you do.
Yeah. Well, the only contradiction on that, what I have, Mike, is if you go to assets like Layer 0 or Eigenlayer, for instance, right? They did both. So some investors hold shares which aren't tradable at this point. At least we are not trading those because nobody's interested in purchasing those. So what do you do? What's your point of view on that, on those?
I'm a big fan of those teams. They should have spent more time in Korea before their token launch.
There you
go. How else in the venture space, maybe Samantha and James, does earlier opportunities for liquidity affect the venture mandate as a whole, which is typically, 5 years plus in the crypto space? How do you approach that?
I think certainly the IPO market has shown that there is exits down the equity route for latter stage companies, although those are a long way away for founders. And I think arguably this pushes many projects, especially investors, to push their projects into launching tokens at some stage, which is arguably in some situations the right thing to do. Sometimes it's not the right thing to do. You'd rather have a team that is focused on growing, creating sustainable revenue, building traction, rather than thinking about tokenomics and other aspects of what is a token launch. I think the poly market example is a very, very interesting one where the ownership is on the equity side, but there is arguably a case for a token. In terms of like value accretion, everything is coming back to either the equity or, in this case, with buybacks, the token, but that's not normally the case. And the token incentivizes users. There's actually a reason for a token. So when projects launch a token, I always ask why. Like, what is the utility? Is it utility, or is it, as Samantha mentions, is it some kind of quasi-equity type play when you have a token? Is it some kind of ownership? Is it some kind of revenue accreting to it? And I think that's what very early stage founders need to think about. Like, if they are looking for exit opportunities, why are they not able to grow the business? Or could they go down some of the routes of secondaries, purchases? Are they able to get strategic investors on the cap table that may purchase their business as a slim part of that bigger operational stack?
So I'll take the other side. I don't think Polymarket should have a token. Because your premise there is if you have a reason to incentivize users, every company everywhere wants something from their users, right? Like, this chair maker would like me to go and post that it felt really good. Like, everyone wants something. I think there has to be a higher bar than that. And by the way, the moment you introduce a monetary reward, right? So whether you're there are a lot of open source communities that have achieved quite a bit of people who just do things because they want to contribute. The moment that's introduced, you're kind of screwed if it's kind of correlated to a wider market and it tanks, right? And I think there was a project, Numeri, that I think about a lot, and it's actually doing well now because the market's back up, but it's a decentralized hedge fund. And there are a ton of kind of data scientists run these models, whatever, they send them in. People will do that in their time because they're passionate. If they're making X amount a month, and then suddenly for doing the exact same thing, because of something out of their control, they're making pennies, that kind of screws with your enthusiasm for it. So I think, if for users in Polymarket, it's, hey, I want you to go and participate, I want you to do that because you enjoy it, right? And I think that's what's happening right now. But if you start to get a price every month for that time and it goes to nothing, I worry about this. Why introduce that sustainability risk?
Let me say two things. First, how would you solve the employee thing? That's one. And the second, would you say the same thing if you were an investor in Polymarket as well?
I would love a token. We invested in their seed. I would love to see a token on Polymarket. I also, but it's a risk reward, right? I think Shane wants to be probably a U.S. listed company at some point relatively soon. That probably inhibits the ability to do a revenue buyback model, right? So then it's a governance asset. Maybe there's some comps that you can pull on BNB to Binance. It's effectively an exchange token. But does that impact what, the founder's ultimate goal is? Can you keep it kind of walled between your offshore and onshore user base? There's a lot to consider. So it's not that simple when you have a very strong current business model that doesn't necessarily require it. To introduce that, you need to think about a lot of those things. But as an investor, I would love to see a token.
I know. That has always been the pain on my end. We all see a token or an equity setup, but then when it comes to investment from your own perspective, then you're always pro token, obviously. They're give me the token because I can have much quicker liquidity than any other IPO or whatever. Same goes for employees as well, to be honest, because some of those guys, I'm just going to name another example, DYDX. The guys got their tokens on 2023 something. And then the price dropped from December from $4 to $1. And those guys were waiting already for 3 years to get their liquidity event. Horrible for those guys, obviously. But yeah, that's the whole dynamics of IPO or token or whatever.
Yeah, really interesting. viewing the market in kind of early stage, pre-seed, seed, Series A rounds as a whole, where do you see outperformance coming from over the next couple of years, and what do you think will get kind of the largest inflows of capital kind of by sector within the industry?
I think the biggest market over the next 5 years is on-chain finance, specifically on-chain credit. Probably gets the most flows. I mean, now that we've
It's a very DAS answer of you.
Yeah, I mean, no, now that we've got stablecoin regulation, we have increasingly larger infrastructure. Like it's just to me, you just look towards naturally large and increasing markets, and crypto and on-chain finance have always sort of been a key area of focus for me, and it's probably the first time since 2017 that I feel like it can actually, elevate to that level. It's not going to displace it over the next 2 to 3 years because it's not good enough yet, but I think it will. And then I think about it as sort of barbell, sort of like vices, sort of human vices and what that dictates, and then the world of capital. And so, yeah, I mean, I think anything that draw massive network effects, whether it be meme coin launch pads or gambling or, and then anything that generates forms of credit. So lending, liquid staking. So the world of credit, on-chain, retail, institutional, and vices.
Yeah.
Your long degeneracy.
I think what we have on our end, we have these monthly reports which we provide, which give you an oversight of how the transactions have happened on a secondary market. We review those. We did just report with one of your competitors out there. And then what came out of that is L1s and service were actually the highest valuations on the OTC on valuation level that you can mark those up. But right now, the poly market and the pump funds and everything coming into play as DApps has changed that a bit. And that's a good thing, definitely, because then people can say, and also for investors, that they can say, you know what, there's more to it than only L1s, investing only in those, getting the 10 billion, 20 billion valuation out of there. On our end, what we see is things like SocialFi, GameFi, those kind of stuff have underperformed in the last year or so, 2 maybe, whereas in beginning of 23 it was hype of the market with Illuvium, Star Atlas, ranging at $1,500, etc., etc. So those are the movements that we see on the OTC side, because at the end, it's all about the gains. At least that's what the whole investment is all about as well.
I mean, I totally agree with the kind of areas that you're focusing on. I think what really makes them stand out is that they found product market fit pretty early and they scaled, whereas there's other areas that we look that are a little bit more nascent, for example, crypto AI intersection, that potentially could be one of those over the next 5 to 10 years, but they're still trying to find that product market fit. They're still trying to get towards any kind of MVP or POC in any kind of credible format, whereas the others have had the last 5, 6 years to test it out, flesh it out, and they've found it. So then it's just about scaling at scale distribution.
True. And one added space is robotics, by the way. In the last year or so, I've seen people from crypto moving also into robotics and AIs, like Figure AI, Apptronic, and many others. And I'm also amazed in seeing that growth itself as well. Like, hey, wait a second, there are some shifts, some crossovers into equities, but also towards other spaces itself. And that's an interesting setup, because what you get at some point is AI, robotics, and crypto intertwined with each other and creating something new, which wasn't there a year or 2 ago. And that's another emerging market that I see at this point.
Yeah, I mean, I think probably agree with the on-chain finance, but within that, I think structured products that are blockchain native. So things that don't, like for me, it's the kind of not replicas. So obviously it's different than the first iteration of tokenization, which has been a lot of like, take this thing that exists in traditional markets and paste it on chain, maybe in the hope that there's a fertile capital base there. I don't think that's really, I don't think the 5 BUIDL holders suggest that that's really playing out. And yeah, so I think it's more a question of what can uniquely exist on chain, right? Is it a new cash flow or a mix of exposures, right? So like projects where there's something that's kind of a real world volatility profile and then a crypto collateral, right? And so there's an interplay. I think that's interesting. And then, yeah, I think, James, you kind of said for those they exist, but now it's about scaling. With the venture hat, I think, okay, what's the room for new entrants then? There's a bit of playing around them. But then you do come back to okay, if the low-hanging fruit is taken, then the next thing is people who have domain expertise, right? And who come from an industry, perhaps one of the ones you mentioned or something else, and are like using crypto blockchain in some way to change it, but that changes the founder profile, right? It's not like crypto devs or enthusiasts building for other crypto dev and kind of hybrid finance enthusiasts. It's someone maybe being evangelized by all of us and then bringing that to another space. So, yeah.
But I think that's exciting. There are massive economies of scales in certain verticals that you invest in, and that's great. And these will arguably be some of the winners. And long-term market structure is going to end up being some kind of oligopolistic, maybe monopolistic, duopolistic in various sectors. That doesn't mean that there aren't great opportunities out there. There's certain parts of the stack that are often underlooked, and these will end up being acquired by the big players. You've seen the rise in M&A activity across all the major exchanges. A number of the traditional finance players have been buying stablecoin or stablecoin infrastructure plays, and that's fantastic, both from a kind of market structure perspective and integrating these solutions into existing tech stacks, but also from an investor, it means that you can focus on maybe underappreciated and less sexy areas, but still get that exit earlier on and get that capital return to investors.
Yeah. Let me name two on those level. Copper, which has done phenomenal when the Buybet thing happened. Undervalued, and in my opinion, on the secondary market itself as well. But at some point, people would look at it and they're like, okay, that could be an interesting thing. They haven't done very well on the financial side, which they could do much better on. And other thing is Consensus, obviously, underperformed as well. And the valuation is, in my opinion, I would say, still a bit too low. It could be much better. But those are the two things that we see on the OTC side, still undervalued. Probably there are many others which we haven't seen in our own, but that's what I can name at this point. Yeah.
Are they undervalued relative to cash flows, or?
I would probably say in terms of valuation and the infrastructure that they have already built. That's what I would say. Third one could be Wallet Connect, because if you take out Wallet Connect from all levels, like custodians and everything, you can't use any DApps basically. That's it. You're done. BitGo, Fireblocks, all those things have integrated Wallet Connect, and they are basically the only one out there. And those are the things that we look at and like, oh yeah, could be an interesting thing. And our clients look at them and they think about it, but it takes a bit of time to pull the trigger and to get that deal done if there is any options out there.
That's great. So let's round it out on a note of credit. You mentioned on-chain credit, but would love to kind of get perspectives on the state of credit in the markets right now. I think the events of Friday kind of have people asking where's there maybe a systemic risk in the markets, and that drawdown seemed to have been due to auto deleveraging in the perps market. But how would you kind of, answer the question, where is credit right now compared to cycles past?
So I guess you break down credit into a few different buckets, but what I had mentioned was more kind of the emerging traditional side of credit. But our market lacks underwriters, like real, proper, intelligent, strong underwriters with experience underwriting traditional credit. Collateralized, over-collateralized lending on Bitcoin and ETH, like that can be very much systematic. There's a lot of nuance in the traditional credit world, which is much, much larger, that I think requires a new set, an emerging set of credit underwriters. And so I think that part is critical. We're starting to see, a few of those emerge. You're starting to see the idea of curation and vault, for example, vault curation. But even there, I think we just need to continue to elevate, and we as an industry need to recruit those smart people. So that I think is probably one of the most underserved parts of the market that can have the biggest impact. Yeah, I mean, generally, it seems to me, and, that on-chain credit worked generally. And again, this was something that this was the same stuff that happened, during the FTX debacle, right? I mean, it's the same thing that happened during 3 Arrows. DEX's decentralized infrastructure tended to work better, more transparently, more efficiently than centralized. So in the world of credit, I think we've had that now for a couple of years. Obviously with a little bit of dysfunction in certain oracles, but generally it's done well. And now I think as we proceed towards different parts of the market, the underwriting is going to be important. Also, basically, and I think kind of you mentioned this a little bit, but you want to go into areas that are digitally native so that you can originate on chain, you can manage all of the rights that are associated with them on chain, something like intellectual property, for example, because running dual custody, having off-chain regulated custody of a traditional finance product alongside your digital representation cost, you're increasing costs. You might be reducing might be increasing efficiencies, but you're reducing costs. And maybe you're introducing composability. But I think we need a little bit more on the infra side and definitely better underwriting.
I think that might be the answer to your earlier question of why Figure did so much better than Gemini. Beyond that, it might be that originating on-chain was the sexy differentiator. Yeah, I mean...
Profitability.
Could also be a factor. But yeah, I mean, I guess I'll then tag on. Yeah, so we provide liquidity or are active on most lending platforms. So Camino types, we're on Morpho, Hyperlend. None of them had bad debt. That's the way they're structured. And overall, right now, leverage in DeFi hasn't changed that much, right, since Friday's events. It's the centralized. But like if we use as a proxy USDC borrow on Aave, I think it went from like 4.5 to like 4.2 today, which is basically just to say the leverage level is pretty consistent in DeFi. Where there's a massive shift is obviously the liquidations that happened in CeFi, and then so the state of it.
Makes sense. That's great. James, Omar, any thoughts there?
No, I think the only thing that I had for Mike is, how do you see the underwriting, Mike? I mean, is there a protocol that should be built to do those kind of stuff? Should it be the sexes doing that? I assume not.
I mean,
but
it's
go ahead.
like any industry, right? Like, are lawyers and financial analysts going to use AI to support what they do? But can it take can it do 80% of the work? Yes, but that 20% of structuring and nuance that you can't necessarily pull, at least right now, through AI or other formats. So. But again, you need, even with AI, you need someone who's intelligently prompting the software. So because credit is, particularly private credit, is so nuanced, it's hard to systematically reproduce. And I think it's been tried time and time again, and it's only blown up, time and time again. So no, we need real people.
Is there, because the underwriting job is identifying like mispriced risks. So is there a type of risk, can be specific, or a type that you think is particularly mispriced?
I mean, even something as simple as like asset-backed lending, right? So the team that I keep referencing particularly, they're experts in special situations, opportunistic credit. A lot of that ends up being asset-backed lending. Yeah, I mean, I don't know. Any investment is you're assuming something's mispriced. In the world of on-chain credit, something is mispriced only to the extent arbitrageurs are willing to come into the market. So they can stay mispriced for as long as you'd like. And, in the world of private credit, the deals are much more structurally independent. But when you look at something like on-chain lending and USDC on Aave or Morpho, whatever it might be, the efficiency is dependent upon the market participants. The markets can stay, irrational longer than you can stay solvent.
What needs to happen for there to be incremental demand for on-chain credit? Is it...
Okay, so go back to mispricing. There's a lot of incentive models that work in the crypto world, and I think if you can find ways to competitively misprice the credit or create a better structure in the credit, so whether that means you go to a protocol and you say, we're willing to work with your particular chain, your protocol, what we would want to see here is we're professional underwriters, we hope to never tap into this, but could you provide sort of 10 to 20% first loss on any of our deals? That dramatically shifts the investment to an incredibly, incredibly attractive piece of credit. Because, $1 of TVL does not equate to 1% in the underlier, people are willing to do that. You want to incentivize usage of your blockchain. You can do that in ways that really benefit. To you, it's a, you know, maybe a slight potential cost. Hopefully not. Hopefully the underwriters are strong enough where you wouldn't have to tap into those losses. But if you're able to get that type of agreement or something similar to that, right? That's just an example. There's a lot of ways to structure these things that can make them extremely attractive relative to traditional markets.
And one thing missing there is the insurance model. There is still not a proper setup. I mean, Binance jumped in on Ethena to pick the tab there. If they weren't there, Ethena was basically done, at least.
Because it was an engineering complacency.
Sure.
All right, we got time for one more question. Let's do a speed round. Here to our lovely DAS audience who's more institutional. You all live on chain, live on crypto Twitter. What's something obvious to you as kind of incrementally more crypto native that's not obvious to the institutional crowd? Putting you on the spot.
On-chain base level yields are accessible and substantially better than traditional yields. So take your savings in money markets and bring them on-chain.
That makes sense.
The blurring between prediction and gambling markets is going to become pretty much one over time.
If an OTC deal is too good to be true, it is too good to be true. Don't buy it. Go ahead.
Integrating is easy and real. So this thing what do they call it? Composability in DeFi was a buzzword that for a long time felt like bullshit, but it's happening pretty systematically. So take an asset, put it somewhere, easy borrow against it, track that, use it elsewhere. That flow doesn't exist in TradFi, and it's actually a better product.
Well, thank you to you all. Thanks for sharing your insights. Thanks for hanging around to the end of the day. Make sure to leave your headphones here and join us at the Walrus and the Carpenter for drinks on Blockworks at 5:30. So see you there.